Hi, everyone. I'm Rick Benson. Today is Tuesday, March 14th. Welcome to this week's In the No Trader show. Well, from a snowy, cold New York day that is definitely a sweatshirt, not put on the contact lens type day and just hang out at home, we're going to take a look at what's going on. And we've got a sharp rebound in the market today after the CPI number came in as expected. A lot of people are thinking this is going to reduce the odds that the Fed raises rates next week. But I want to, let's get into the agenda. What I want to spend time talking about this week is how to exploit what other people in the marketplace get wrong. And that'll be the subject of what we talk about. Before we do that, I want to remind you of the products that we have here at In the No Trader that you can subscribe to. We have a weekly ETF Tactical Trader Report, generally comes out Thursday nights, goes into a deep dive across the major asset classes that affect the stock market. And of course, if you're a trader, you've got to know what's going on in the bond market, in credit spreads, in the dollar. Generally, we look at gold too, so we give you a good background on that. We do a deep dive into the S&P and what I'm thinking both short-term and medium-term as far as positioning and the best way to both tactically and strategically play the markets. I give you a new ETF trading idea each week, and also walk through all open positions that we have from prior weeks until we close out the trade. So that is potentially moving sell stops up or down to protect profits, potentially changing targets, which is not something I do frequently. Usually the targets we set out when we first get into something are the targets we play off of. And this report, again, a weekly report, is a good way to keep on top of all the macro events that are affecting how stocks trade. Secondly, we have a product that comes out once a month, and almost always on the last day of the month, which is called the 7-11 report. The goal of this report is to outperform the S&P 500 by being in no more than 7 of the 11 macro spider ETFs that exist. There are, of course, 11 sectors to the market, macroeconomic sectors such as utilities, staples, technology, materials, consumer discretionary, and so on. Each one of those has a spider ETF that starts with the ticker XL. So XLK is technology, XLP is staples, etc. What we do is pick no more than 7 of the 11 sectors to be in at the beginning of each month with the goal of outperforming the S&P. And here's how we've done both recently and historically. So through the end of February of this year, we have outperformed the S&P by, outperformed the S&P by 6% last year, outperformed by 11 basis points in February, but still down on the year because of the massive movement in January. And since we started this 31 months ago, so approximately 2.5 years, we've outperformed the S&P by just over 10%, averaging just about 4% a year in outperformance. If you were to look across the investing world of those who benchmark against the S&P and only invest in S&P 500 names, and of course we're doing it on a sector basis, our results would put us in the top 10% of all people who do this. So if you've got money parked in spiders, if you're thinking of investing in the market through ETFs instead of individual stocks, this is certainly a way to put some of the money that you have invested for the long term in the marketplace with a better chance than most people have of outperforming the market over time. So this is not like a hedge fund. This is not aiming to make money regardless of which way the market goes. The goal here is to outperform the market. So last year, when the S&P was down about 19%, we were down about 13%. The year before, when the S&P was up 28%, we were up about 32% or so. So the goal is to just simply do better than the S&P does. And it may sound like an easy thing, but I can tell you 6 out of 7 people on Wall Street cannot do this. and very few can do it over time. So that's a product we've had that has been inordinately successful. And if you're an individual investor or a financial advisor and you have client money in spiders or Qs, the QQQ, consider putting some money and following the advice of the 7-Eleven report. The third product we have is not written, but actually coaching services that I offer. And again, whether you're an individual investor or a financial advisor, I do a substantial amount of coaching. The information is on our website, inthenotrader.com. You can sign up for a single session. There are hourly sessions. You can sign up for a package of 3 at a very nice discount. We have people doing everything from 1 to usually, I'd say 5 to 6 sessions. And the goal here is to make a material improvement upon the process that you use, whether, again, as an individual investor or if you're a financial advisor, how to better communicate with your clients, have better client retention, and understand how markets move in a much better way than you typically get from any type training or experience you have yourself from being in the marketplace. So that's what we have in the No Trader. You can subscribe to my In the No Trader YouTube channel by going to youtube.com/InTheNoTrader. Click on the subscribe button, and then anytime you open YouTube, the most recent videos I do will be right on top. And you can follow us on Twitter at InTheNoTrader. So let's get back to this idea and the lesson of the week about exploiting what others get wrong. And this is basically the approach I use to everything I do in the marketplace. Having a significant background like I do in behavioral finance and economic theory, and having been the first to teach that at New York University and running their entire certificate program, that's the word, I was trying to remember it, that they developed 15 years ago or so. I look at almost everything I do in the market from a perspective of who's on the wrong side of the trade, how much is there likely to go, and what is the thought process to the person who's on the wrong side of the market right now. And probably the easiest way to think about this, given the recent news of this past week, is to look at some of the banking stocks and to see what they're doing. They're actually, the regional banks are having a massive rebound today, but we need to put that into the context of how are people positioned in some of these names, and what's the likelihood of this week's low being the bottom of the move and a material comeback happening over time, or was what has just happened changed the game on the medium-term picture in those names, in which case you may be looking to sell rallies. So let's take a look. Let me bring up a chart here, and let's start with First Republic Bank, which was in significant trouble last week and certainly the early part of this week. So here's a chart. Basic support resistance levels, not going into fancy stuff right now. However, a couple things to pay attention to. Last week had a sequential 13 downside exhaustion signal. You can see prior signals, upside exhaustion here in 2017, sells off for, takes a year and a half to get, actually even more than that, to get almost 2 years to get above that level. Another upside exhaustion signal in late 2019, goes slightly higher and then collapses into, of course, what ended up being COVID. Nothing on the top, but now on the way down, we're seeing downside exhaustion. So do I want to be a seller in First Republic right now? No, of course not. But let's look at the bigger picture here. This goes back 5+ years. And we're looking at every single owner of First Republic Bank in the last 5+ years is currently underwater. That puts, in my view, a tremendous overhead supply in this name. And then the question is, where are the bulk of the sellers going to start showing up to reduce their long positions? So again, I'm not looking to be a seller now. I've got enough reason. Look how low the RSI got this week. It's currently at 20. This is the lowest level you've seen on the entire chart. So we're deeply oversold. Certainly, I don't want to be a seller. But how do I take advantage of the people who've got this wrong? Whether they were right for the right reasons or right for the wrong reasons over the last several years, everybody was happy until the beginning of last year, when, of course, the market sold off and dragged banking stocks down with it. And then we got a bounce recently, and as this year started off with a good bounce, but then, of course, we have fallen apart. So I've identified here prior support levels in which there should be some selling. So anywhere from, and of course the numbers here are going to be big because of the huge movement. So we can say anywhere from, let's call it 73 up to about 80 or so, where these horizontal dashed purple lines got taken out on the move over the last week or two. Up to even as high as 100, which was the double bottom in 2020 after the COVID low was made. And even here we can see last year's low at 106. So we can even say from 100 to 106. So here, if we start to blow this up, and let's put on, let's say, a cloud chart to see. Now the cloud chart has completely broken. It actually broke in the middle of 2022. And now we look at where's first resistance on the cloud chart. Well, right now we're talking about that's 82 and change as of this week. And let's see, 2, 3, 4, 5, 6, 7. It's going to stay there next week unless we make a new low under this week's low, which probably is not going to happen. So we know for the next week or two, 82 and change is going to be resistance. And I don't know if it snaps back that much, but I certainly would think that there's a good chance that the first time we hit the cloud's conversion line, and again, it's hidden a little bit beneath price action, but you can see where the current value is here at 82.61. There should be some resistance, and it's going to be right around the area that we have from where this really broke down from. So there are very possibly trades coming up on a rally. And again, think in terms of 5 years worth of buyers have lost money on this trade. And they're all going to be thinking, how do I get out of this and minimize losses? Because everybody has a loss and everybody is thinking the same thing. There'll be some bottom fishers here, and those who bought this week already saw the stock go from $20 to $45. So for very short-term traders, obviously from what we saw from yesterday's low until where we're trading now is a significant bounce. But that's very short-term tactical trading. When we think of this in the big picture and we look at this massive breakdown, we know this whole area that I'm circling is going to be resistance, and it's just a matter of kind of picking where you would potentially put on a short, where if you're long you would think of getting out, where on a bounce you could sell upside call spreads. There's a lot of things that you can do that play this name defensively on a potential rebound coming up. And that's what I think you're going to want to do, regardless of what you hear from pundits on TV who have no better clue than you do as to what's really going to happen. I'll say that you actually generally have an edge over them if you know how to chart well and use models that are more effective than the average models. Now, most of what I have up here is what any basic technician is going to look at: prior support potentially becoming resistance. I think what we add to the picture here is the fact that we've also understand the cloud model in a way that few do. The cloud model is something that I brought to the Western world in the late 1990s. I have taught more people about how to use the cloud model, especially on the institutional side, than any single person in the Western world. And fair to say from the public comments made over the last 25 years that I am generally considered the foremost expert on how to properly implement this model. Now, there are books out there There are occasionally people writing about it. What I will tell you is that generally they are no more than 50% correct on their interpretation of how to use this model. Most of the stuff that is in print is not correct. And I've let it stay that way for as many years as since I first learned this model in the late 1990s. And I've had 3 book offers from 3 different publishers to write the definitive guide to this. And I choose not to because it is a huge competitive advantage of my clients to have my interpretation of this. And I don't publicly put this out other than to individual clients who are subscribers, because the misinformation out there on how to use this model is actually something that, again, we can exploit. And I do frequently. So even people who, let's say, back to earlier days in my career when I was on the sell side of Wall Street and chief strategist at several firms, and I introduced this model to people I work with and people I hired, I see frequently how wrong they are in truly understanding how this model works. And that's because part of it is I only shared the basics with them, and it's the only thing I share with everybody is just basics. But my interpretation of how to use this goes well beyond the basics. And that's the advantage that clients have who subscribe to the variety of products that I put out. So yes, I'd be looking to sell these names on a rally, despite the fact that in percentage terms, there still may be an effective shorter term trade to the upside. To me, the bigger correct play is to sell into a rally because you have so many trap players here. And that's taking advantage of what other people got wrong. And again, is it their fault they got it wrong? The fundamentals might have been very good for this bank, but whatever those were have to some degree changed in the last 2 weeks. And when you have 5 years of players who are trapped long in something that just took a major hit, you know there's going to be substantial selling on the way up. Let's take a look at one other chart that came across today, and this is Charles Schwab. Now, Charles Schwab has a bank associated to it, and they are not as materially affected as a place like First Republic, and certainly, obviously, Sovereign and Signature, and those 2 banks are closed now, but their stock in sympathy got hit hard. So what do we see here? We see that this week's down, this is a weekly chart of Charles Schwab. This week's down move has now bounced off of, yesterday it was weaker, but bounced off of the bearish propulsion full exhaustion level. So in other words, from the breakdown that happened just 3 weeks ago, it suggested from a price at the upper 70s that on a material breakdown, this could get as low as 49 and change. And that's exactly what has happened. So could we bounce here? Yes. If I look at we had a double bottom here from last year. That's the horizontal line at 59 and change. We've broken beneath this major uptrend line. The cloud model has broken. So anywhere from currently, let's call it 65 to anywhere from, call it 59 to 65 is going to be where I expect resistance. And I can tell you that today, so the stock is up $3 and change, but the high today is 61.11, and it's currently trading at 55. So it's off $6 from the high. And I can tell you I missed by less than 50 cents with a limit sell order today to have gotten short the name. And I still have it as an open order. I may not keep it because if I'll have to determine if it's still the right place. But even something as I didn't know or particularly play this to be that it would have been a day trade. But if I had gotten the sell order off today, I'd probably already be taking partial profits because I would have had a 10% gain in a few hours. In the bigger picture, you still have people trapped, not as many years. This is only a couple of years for Charles Schwab, but you have this big rounding top that broke. And again, it could be a fake 1 or 2 week type event, but you're still going to have a lot of trout players. So anywhere, again, from 59 to let's call it 65 or so, is where you're going to see a lot of people who are long this name be willing to take their losses and just get out. And this could be, some dead money for quite some time to come. So do I want to be a seller down here at an RSI of 27 and the lowest level we've seen in a few years? I do not. I look, if I was stuck long, I might be forced to do that. But given that I have no position in this name, same thing. I'm going to try to take advantage of what other people got wrong. And again, can I blame somebody who 3 weeks ago had a stock at almost, $80 that sold off to 45 this week, losing almost 50% of its value? Let's call it 40% in 3 weeks. They're not to blame, but it's their money that right now is losing, and they're the ones feeling the pressure to either buy more and try to average out or to just manage that loss. And so I'm going to lean into where I think it's proper, joined by others who are in a more difficult situation than I would be or you would be if you're first trying to put on a bearish bet here. But same type thing, if we get up into the zone, I don't see a reason why you can't sell upside calls or call spreads, or if you're long, certainly look to reduce in either selling out of stock or selling calls against what you have, etc., and or buying puts. That's how I think one of the ways of many that I look at the markets to take advantage of what other people got wrong. And again, it never matters if investors are right for the right reasons, right for a certain amount of time for the wrong reasons. You can also be wrong for the wrong reasons and wrong for the right reasons. But that's all stuff that's kind of stuck in your head and irrelevant when it comes down to approaching a stock or an ETF, looking and assessing and determining where's the big picture play, who's on the wrong side of the market, how much pain are they feeling, excuse me, and there's a lot more analysis that I could go into on a deeper level than simply looking at a weekly chart, putting up a few lines and a cloud model. But I can tell you that there's sometimes things are not as difficult as they need to be. And the likelihood that this just turns around and flies to the upside, given a few years worth of people who are trapped in this, is not high. So the odds favor you to lean into rallies into these banks against resistance levels and join those who have to sell in order to take advantage of another move down. And that's all I've got to say this week. It's I've been trying to cut these down now, these weekly in the No Trader shows, to just concentrating on an educational point of view, something that you can learn from and incorporate into your own trading. And I think just based on some of the feedback I've had, it's the best way that we can do this. We keep the time to a minimum, roughly 20 minutes, give or take, and get you good, solid information from someone who's hopefully a good resource to you with over 40 years experience in the market, both in multiple levels. Certainly, I traded in the commodities pits for 12 years. I was on the sell side for many years in some of the highest positions you can have on Wall Street. I've been on the buy side helping manage a multi-billion-dollar fund. And so I give you a perspective of somebody who's only doing this for my way of giving back for a successful 40-year career and helping people who have less knowledge to understand how the pros play this game at the high level that they do. So that's it for the week. I hope you enjoyed the show. I'm Rick Bensignor, and this has been In the No Trader.